44%. That is the share of home insurance claims the 5 biggest insurers in America did not pay last year. Not denied because of fraud. Not denied because you missed a payment. Just not paid. State Farm, Allstate, Farmers, Liberty Mutual, USAA. The companies on the side of your mailbox. The ones you have been paying every month for years. 44% of the time, when you needed them, they did not pay. And that is only part of the story. Because the bigger story, the one that is happening right now in California, Florida, Louisiana, Oklahoma, and 11 other states, is that these companies are not just denying your claims, they are leaving, canceling policies, refusing renewals, abandoning entire states, and leaving millions of American homeowners with nowhere to go. Today, we follow the money, from your monthly premium to the boardroom decision that left your home unprotected. Let's follow the money. Let's start with names. State Farm is the largest home insurance company in America. In May 2023, it stopped writing all new homeowner policies in California entirely. It blamed historic increases in construction costs, growing catastrophe exposure, and a challenging reinsurance market. Allstate, the second largest, stopped new home and condo policies in California the same year. AIG, Chubb, The Hartford, and Tokio Marine followed. In Florida, 12 home insurers exited or suspended new policies in 2022 alone. Farmers Insurance left Florida entirely in summer 2023. In Louisiana, at least a dozen home insurers left following 4 major hurricanes in 2020 and 2021. AIG announced it was pulling back from as many as 200 zip codes across New York, Delaware, Colorado, Montana, Idaho, and Wyoming. Between 2019 and 2024, State Farm, Allstate and Farmers alone collectively dropped over 100,000 California homeowners. These are not small regional companies struggling to survive. State Farm reported over $140 billion in assets. Allstate reported record underwriting profit in 2024. These are some of the most profitable corporations in America, and they are choosing to leave. The question is not whether they can afford to stay. The question is whether they calculated it was more profitable to go. And the answer, based on their own financial statements, is yes. Now let's talk about the claims they are not paying. The Wall Street Journal published an analysis in 2026 examining the 5 biggest home insurance groups: Allstate, Farmers, Liberty Mutual, State Farm, and USAA. What they found was this: 44% of homeowner claims resolved last year were not paid out. Not 44% denied for fraud. Not 44% denied for missing paperwork. 44% of the time, when a homeowner filed a legitimate claim, the company found a reason, any reason, not to pay. And that number is rising. A decade ago, it was 36%. Today, it is 44%. The trend is moving in one direction. Florida recorded the highest rate. More than 2 in 5 homeowner claims in Florida received nothing, largely because of technicalities around flood versus wind damage during hurricanes. Your roof was destroyed by the hurricane. The insurer says it was the flood, not the wind, and your policy covers wind, not flood. $0. Texas and California where wildfires and tornadoes caused the most damage, also reported among the highest non-payment rates. USAA responded to the Wall Street Journal by saying their analysis did not account for claims below policy deductibles and claims customers chose not to pursue. When those were included, fewer than 6% of USAA claims were ultimately denied. That is one company's explanation. The other 4 did not offer one. So the companies are leaving, and when they stay, they are not paying claims. But here is the third part of this story that most people have not connected yet. The premiums are going up anyway. Homeowners insurance premiums increased in 95% of U.S. zip codes between 2021 and 2024. Not in some states, not in high-risk zones, in 95% of American zip codes, virtually everywhere. The national average is now $2,604 per year. In Florida, it is $7,136. In Oklahoma, $6,034. In Nebraska and Louisiana, similar numbers. Home insurance now accounts for 9.55% of the typical American homeowner's monthly payment, the highest share on record. State Farm requested an emergency rate increase of 17% in California in 2025, on top of existing premium increases, then requested more. In Illinois, State Farm filed for a 27% rate increase. Allstate filed for 9%, on top of that for 200,000 Illinois policyholders. The governor of Illinois called it, in his own words, nothing short of a crisis. You are paying more, getting less, and being dropped when you need it most. When a private insurer drops you, where do you go? Most states have what is called a FAIR plan, fair access to insurance requirements. It is the insurer of last resort, the government-backed plan designed for homeowners who cannot get private coverage. In California, FAIR plan enrollment surged 43% between September 2024 and December 2025, 668,000 policies by early 2026. Following the devastating Los Angeles wildfires, the surge accelerated even further. Here is what the FAIR plan actually offers. It covers fire only, not theft, not water damage, not liability, fire only. And it costs approximately 3 times the premium of a standard private policy. So when State Farm drops you, you pay 3 times as much for a fraction of the coverage from a government plan that was never designed to be your permanent insurer. Redditors across California describe, and I am summarizing their words, paying more for less protection with long delays in claim responses. The FAIR plan was the safety net. When the safety net becomes the primary option for 668,000 Californians, the system has already broken. Here is the connection that almost nobody is making. Your mortgage requires home insurance. It is not optional. It is a condition of your loan. If your insurer drops you and you cannot find replacement coverage, your lender can declare your mortgage in default. Not because you missed a payment, because you are uninsured. And in 2026, a recent survey found that nearly half of home buyers and sellers encountered insurance issues during their transaction. 21% of home transactions fell through entirely because of insurance problems. Not financing, not inspections, not price disagreements, insurance. The home was ready, the buyer was qualified, the deal died because no insurer would cover the property. This is now a housing market crisis on top of an insurance market crisis. The same buyers we discussed in video 03, the ones already competing with algorithmic investors for a limited supply of homes, are now also competing to find insurance for the homes they manage to buy. Layer by layer, the path to home ownership is being blocked from every direction simultaneously. Here is what most people have not heard yet. California wildfires caused $40 billion in covered property damage in the first half of 2025 alone. That was 50% of the world's total insured natural catastrophe losses during that period. 50% of the world from one state in 6 months. Insurers are not leaving because they are incompetent or because they are uniquely greedy. They are leaving because the mathematics of insuring homes in specific American zip codes no longer works. Climate change is the engine behind this crisis. 14 of California's 20 most destructive fires occurred in the last decade. The number of weather and climate disasters causing more than $1 billion in damage increased fivefold between 2018 and 2022 compared to the 1980s. Insurers run actuarial models. They calculate the probability of a claim against the premium they charge. When the probability of catastrophic loss becomes too high to price profitably, they leave. 15 states are now facing an imminent insurance crisis, according to Insurify's 2026 analysis. The states at highest risk, California, Florida, Louisiana, Texas, Oklahoma, are also among the most populated states in America. And the delayed bomb, the part that has not hit yet, is that tariffs on building materials like Canadian lumber are now pushing rebuild costs higher. When a home burns and costs more to rebuild, the insurer's liability grows, which means more exits, more denials, higher premiums. The crisis is not peaking, it is accelerating. Before the last piece, fairness demands I tell you what the insurers would say. They would say, the risks are real. Climate change has made large parts of America genuinely uninsurable at any commercially viable premium. We are not abandoning homeowners. We are responding to mathematical reality. And they are not entirely wrong. $40 billion in California wildfire losses in 6 months is a genuine catastrophe for any insurer. The maths are real. But here is what they will not say plainly. They collected premiums for decades in the same California zip codes they are now abandoning. They priced those premiums knowing the wildfire risk was rising. They paid shareholders and executives billions while the risk grew. And when the moment came to pay, they left. You paid your premiums every month for years. You never missed a payment. And when your home burned, or flooded, or the roof caved in, the company you trusted found a reason not to pay. 44 cents of every dollar in claims. Gone. Not stolen. Denied. Meanwhile, the companies leaving your state are not going bankrupt. They are reporting record profits. They calculated the risk, and they decided your home, your neighborhood, your state was not worth insuring anymore. Nobody told you this was happening. Nobody asked you if this was acceptable. If this video helped you understand something the news hasn't explained plainly, share it with one person who needs to hear it. That's how this channel grows, not through clickbait, through information that actually matters. We post every week. Subscribe if you want to know what's coming next. Because there's a lot more coming.